Welcome to the Roll-Up. Today's episode is with Rain and Coffee, also known as Mads from Maven11. Maven11 is a VC firm that has invested all across the board, primarily in Modularity, Interop, and ZK Tech. We are super stoked to have this conversation with Rain and Coffee, who has done extensive research on all of these verticals, and personally my favorite, a integrated piece of technology that brings all of these verticals together, which he calls the global state layer. I personally feel like this is kind of the pinnacle for what blockchain user experience can reach, and I am absolutely stoked to share this episode with you as we talk through the technical ins and outs of how this global state layer could look, as well as specific conversation about each of these verticals on their own. Sit back, relax, and enjoy. But first, a word from our sponsors that help make all of this possible. Cartesia is your home for app-specific rollups. At the forefront of developing new tools and platforms that enhance the capabilities of blockchain technology, Cartesia enables applications that are flexible and built to scale. Build on a full Linux environment and use traditional software libraries, but in blockchain development. Go to cartesia.io, that's cartesia.io, to learn more about building your own app chain today.
Welcome back to the Roll-Up. Today we have a podcast with the hated VCs of the world, the bane of crypto's existence, and the reason why we're all going to zero apparently in the current zeitgeist. We've got Rain and Coffee from Maven11 here with Rob. Rob, how does it feel to be in the presence of the hated VC cabal today?
It almost feels like this is like a meeting in that Superman like Fortress of Solitude. I think that's what it was called. And we're plotting the either the inevitable like utopia or dystopia of crypto. So hopefully by the end of this we will figure out which one we'll end up with. Rain and Coffee, it's a pleasure, man. Thanks for coming on. You know, obviously you're at Maven11. Maven11 is a VC that has funded several companies and crypto projects in the space. Absolute pleasure to have you on, man. Thank you for coming.
Yeah, thanks for having me. I maybe wouldn't describe myself as like the biggest VC in the world. I'm more on the researching side, but I have seen the hate we've gotten, and some of it is not unfounded. But I think there's also good defenses for why VCs make a lot of space, a lot of sense in the space.
Yeah, kind of. Could you unpack that? Just like why do you think VCs are getting hate? 180 or so from kind of like maybe the internal crypto ethos of community, but VCs, maybe some would call them a necessary evil if they are evil. Do you think VCs are evil, but like they're really a pretty integral part of this entire ecosystem? So how do you view kind of this sentiment right now towards VCs? Do you think it's warranted?
Well, I get the point when you look at some of the sort of token allocations in some projects recently, where obviously there's lots of insiders. But sort of the defense to that is that these protocols wouldn't have the hype, nor the TVL, nor the amount of development they've seen without the funding from VCs. And like no company in the world that has shareholders or even without shareholders likely to give money to anybody without getting something in return. And most of the time, many of these VCs, ourselves included, have, especially as a pre-seed seed fund, have been working with companies for 2, 3, 4 years and help to make them a success. I think the fact that without VCs, we'll be able to build a lot of stuff that does exist in crypto at this point is probably quite small. Obviously, we have the great early DeFi protocols, the blue chips that sort of came out without any VC funding at all, really. But most of what has been built since then, particularly L1s, L2s, and much of the other stuff we've seen so far in crypto has not come without funding. Most people just are not going to sit and build for 2 or 3 years without any sort of money either paid or neither the people that are working for them. So I do think it is quote unquote like a necessary evil, if you want to call it that. We do see this in any like Web2 tech companies as well, right? Most of them are funded by VCs because you need money to build stuff, and without money, it's kind of difficult to build a lot of these things. On the other hand, though, we are seeing like very cool sort of grassroots developer stuff coming out of hackathons. I think particularly in the modular sector as well, we're seeing a lot of very cool developments and applications that are being opened up just because of the fact that a lot of this stuff is now permissionless and free to use, and quite commoditized to that extent as well.
Just a quick question as far as like kind of like looking at the history of the crypto market and how these projects have gotten funding in the past. The ICO boom of 2017 had a lot of problems associated with it. And now we're in a bit of a different situation in the current era. Could you kind of like, what do you think, why do you think like this time is different? What was wrong about the 2017 era and kind of like the ICO crowdfunding type of movement? And why are we in a different scenario now?
Yeah, so often I think with ICOs in particular, there was no sort of backstop. There was nobody to put checks and balances on the team receiving money. Right, you could receive 50 to 100 million in ETH, and then who is actually making sure that things are going like they should be going? Are they hiring the right people? Are they doing the right things for the marketing? Are they getting work done or whatnot? With VCs, you do kind of get those things. You do have people that are paying close attention because they have a vested interest here. They might be on the board seat of that company or whatever. So you do get more sort of checks and balances to ensure that things are being done correctly, which does lead to more things actually coming out into the market. With ICOs, you kind of don't have that at all. Like they're sort of just being given money, quote unquote, for free, and then you're hoping that something will happen, right? So I would look at it like ICOs are similar to like a Kickstarter. Like you're giving more money at the hope that something eventually comes out of it. While with a VC, you're sort of helping to shape this thing and making sure that it actually becomes a success. With ICOs, you're sort of just giving money and then, okay, maybe 2 or 3 days down the line, this becomes something. I think the chances of success are much higher when you do have checks and balances and people helping you throughout the way. So it's a different way of doing funding. And we still have ICO-esque funding things happening now. We had the pre-sale drama on Solana, which I guess is another way of looking at it at ICOs. I'm assuming we'll see things like initial model offerings on like some of these AI protocols as well. And that will probably be some similarities to what we had previously. We had mints with NFTs as well. So it's definitely something that will continue to happen just because of the way crypto is permissionless, so you can do these things.
Yeah. NIM Network has launched their initial model offerings for their AI work, which I think is pretty cool. And yeah, I mean, I think like Kobe's pioneering this Echo project, which is seemingly trying to bring more syndicates involved. So yeah, I think like with every industry, things kind of balance themselves out over time in the market. People tend to find ways to get opportunities, and I think that we'll see more and more opportunities for like the average folk to invest early. That's the big like pushback. It's like, oh, we don't get the chance, but it's also like you don't have the capital and like also like the accreditations and things. And so, I think that's more like the problem. The last thing that I want to ask you on this front, before we dive into some of the modularity conversation, because I know that you guys are big modular bulls like us, is what do you think about these like high FTV, low float launches versus like some of these lower FTVs, a little more float launches for the potential of growth of the token post launch, as well as like forming a community post launch? Like from a builder's perspective, like are you viewing this as like maybe we should launch in one way is better or the other, or like maybe we can just talk about like the pros and cons of these and kind of how you're seeing the market dynamics play out from some of your portfolio companies or just in general?
Yeah, so the reason we have these like low float type setups is because like the insiders are locked up. So in one way you can look at it as like a good thing. Obviously it looks weird when you have one market cap and then the FTB is 10 times that. But that's because those are locked tokens. And that comes as a result of maybe that project having sold quite a lot to VCs because they have a lot of tokens allocated to themselves, and that is locked. And then you might have like staking rewards that are likely going to be locked as well. I think in general, that's just a result of the way funding is happening now and the amount of things that are locked up. Preferably, you do have this airdrop amount usually, which most projects are launching now with airdrops or points into airdrops. And then you usually have like 17-ish, maybe 15, maybe 20% allocated to that. And that is sort of what you in the beginning will have unlocked. What you could do is, you could have way more liquidity incentives that are unlocked on paper, but are just being given out. But all of the sort of the VC funded tokens are locked up often for a very, very long time. So it's not like VCs are just, dumping the tokens as the token launches. Most VCs and most projects I've ever seen, you are locked up for years at a time, and then that vests over time. So it's in your best interest that the project develops and continues to develop over time. And you're not just, going to Binance and then dumping everything as soon as the token launches. Nobody's doing that. And that's why the FTVs look the way they do.
Yeah, it makes sense. I know I said last one, but second to last one. Do you think that the vesting schedules will extend from like the typical, I don't know, like 1 to 4 years or 2 to 4 years to something more like 3 to 7 years or 4 to 7 years, more akin to like a equity raise in the traditional world? Still shorter, I think, from my understanding. But do you think that that's a way to kind of like level the playing field more, or perhaps settle down the private market froth where it's like, okay, if I get into early stage deals, I'm pretty much going to get a return regardless because of tokens? Like, that's why crypto is like a crazy phenomenon in terms of like the liquidity event happening. Do you think that we see these more elongated vesting schedules compared to what we see now in the future?
I mean, it's a possibility. I think what has to happen first is like two-sided. One, like valuations have to come down because the risk associated with this are just so much higher. So you're no longer thinking on maybe a 4 to 5 year timescale. You might be thinking on a 7 to 10 year timescale. So valuations will have to come down as a result of this, which means you have to raise less money or dilute more. So then you have even worse of these low float things, because you've raised even more money at a lower valuation and giving away more percentage. So that's obviously not ideal. And I just think there's a lot more risk associated in crypto, especially whether that's smart contract risk for an application or just the difficulty of sort of getting users with your protocol. That kind of sort of ties all together. I think it could happen, but I think then the Web3 VC market will have to get a lot more similar to the Web2 VC market. And that would also mean just the risk associated with it and also the valuations as well. And then that could turn even worse over time for sort of the low float things, although those tokens are allowed locked for a lot longer. But you're still going to see these weird charts where, market cap is this way and then you have 20x on the FTV, which I guess is not ideal either.
Yeah, that makes sense. If the risk is still much higher, then extending the vesting doesn't really line up for kind of what people are going to be interested in investing in. And then you kind of have the same problem where you have to dilute more and raise less money at a lower valuation, and just kind of so interesting kind of dynamic. Pulling ourselves out of the behind the scenes of the crypto funding world and pulling us into the modular world. You've got quite the modular haircut there, Rain and Coffee. I know that you've been a modular bull since well before us. So yeah, maybe like just talk us through your modularity kind of journey, how you kind of came about to this idea, and then let's dive into some of the interesting topics that we have today.
Yeah, for sure. So it kind of starts, at least the modular journey starts around 3 years ago. So I've originally got into crypto back in 2013 through Reddit and then Bitcoin talk forums. And then I spent a lot of time in China, got to realize why I think blockchains and not just cryptocurrencies are important, because the experiences I had there. Eventually, I sort of got into Polkadot in 2019, 2020. And I saw so many things that I were doing that I think were quite interesting. And this is sort of precursor to that entire modular sector. We also saw, particularly in 2019, a lot of writing about rollups from Vitalik, Kelvin Fisher, one of these early sort of Ethereum scalability OGs. And that kind of got me very interested, because I would look on Twitter back then, and there was no writing for like the common man about, okay, what is data availability? What does data availability matter for rollups? So I kind of took it upon myself, because I've always been in love with sort of talking about crypto and explaining it to people. So I just started writing. And I think one of the first things I wrote about was, I wrote a thread on Twitter about, okay, this is data availability. This is why rollup need it. And this is why it's not ideal on Ethereum at the QN stage, and why it's so expensive and not like the best way to serve data availability to a rollup. And by doing that, Matthias, who is one of the partners at Maven11, reached out to me on DMs, and he was like, "It sounds like your thesis is kind of similar to us. Should we, get together and talk?" And we did. And I joined Maven11. This is early 2022, so a little bit over 2 years ago. Have been with the fund ever since. And we are sort of, I guess, known sort of for our modular involvement. So we were the very first ticket into Celestia in early 2020. Matthias reached out to Mustafa after having read his PhD paper, which was Lazy Ledger, now Celestia. And since then, we've done a ton of investments sort of in the modular sector as well, namely Astria, Sovereign Labs. I know you have both Gem and also Jocelyn on here. So they're also portfolio companies of ours. We also have investments in interoperability, CK, MEV, DeFi as well. So I personally spent quite a bit of time that is quite broadly. So I'm not, an engineer or super like, I'm not sitting there and writing code day to day, but I do look at a very, very sort of verticals. And with that, I do have to spend a lot of time just reading, whether that is white papers, or what I do most of is like actual like academical research that I sit and write and read. And then you can sort of apply that to some of the white papers you're seeing. So most of the stuff I look at is like pre-seed seed. So most of the ideas are, haven't been built yet. So is this actually possible to invest in? Will this actually work when it comes out? And how can I actually help this? So I spend a lot of time helping our portfolio companies as well. So I probably have a broader view of the crypto space. So I can help our portfolio companies a lot easier. Sometimes if they're building a roll up, or if they're thinking about MEV or things of that matter.
So you guys have this
Awesome.
modular thesis, and you've decided to invest a ton into modularity, and very early. And so you clearly kind of were visionaries in this realm. Rob, I don't know if you had something along the lines of the modular thesis, but I was kind of thinking about, what is the modular thesis to you guys? Like what is modularity in Maven11's view, and why has this become something that you guys have put so much capital and firepower behind? And Rob, I'm curious if you kind of wanted to add to that as well.
Well, to set the stage for that question, you mentioned that you had some experiences in China that were kind of like eye-opening in the sense of like realizing that blockchain applications and not only cryptocurrencies were going to be quite important in the coming years. So I'm curious, like, what were those experiences that kind of like gave you that realization? And then ultimately, how did that lead you to the thesis that you have today?
Yeah, so if you haven't lived in China, it's a pretty authoritarian country. Still is today, has been for a very long time. So most of the sort of availability to go on the internet and go to any web page you'd want to is unavailable for most people. You have to use a VPN. The banking system, the bureaucratic nature of it, the way it's set up, is also very focused on not being very verifiable. So it's generally the non-permissionless aspect of living in a country like that. Makes you have experiences where you're like, oh, blockchains and permissionless networks make a lot of sense. While I think a lot of people don't have this personal experience that early on, until it's too late or until it happens. I think, living back in Denmark when I was young, I never really had experiences that made me think, okay, blockchain and crypto make a ton of sense to me right now, because I was, serviced pretty well by the Danish government. I think in China that is a less of a thing, and then more of an issue there. And the way I sort of got hyped about Celestia in general was particularly because of the nature of light nodes on Celestia. So in my view, like data availability sampling is the only way to like scale a blockchain without losing decentralization. It's actually the opposite. So as you increase decentralization of the amount of nodes in the system, so does the scalability with the amount of data that you can sample. And that kind of spoke to me because, more nodes, more people being a part of a network, higher scalability. And then just the way that data availability to me is sort of the last bastion of truth. So if you have the data that a roll-up or an application has sent to a data availability layer, you can reconstruct everything else that has happened and verify if that has happened is true or not. So for me, it's sort of the last bastion of truth. And for that, I think data availability is quite important. And then beyond that, I just think a lot of the application now on like generalizable smart contract chains like an Ethereum or arbitral optimism are giving away a lot of powers. I think this is particularly related to MEV. There's a lot of MEV that you just cannot capture in this application on a smart contract that is a platform that is generalizable, because you just don't control ordering. There's also just scalability issues. So you're sharing your block space with thousands of other applications. So for me, there's things that Modular fix in that sense. There's also issues that it brings with it. And I think there's ways to fix those issues. And we are working on these issues being fixed, but it's definitely going to be a thing that's on a longer time horizon. But I think the end game of what Modularity brings way more customizability to an app developer. And I would like to assume that people don't want to give up control. They want to, keep their control. And hopefully in future also be composable with others having the same idea.
Very cool to hear that story and why verifiability is so important, and then how modularity helps to scale verifiability. I tend to agree. That's one of the core components of blockchain technology. And so kind of like unpack this for us. I think all of us agree, like the highly customizable, especially when it leads to more scale. This is what is empowering some of these newest applications and newest infrastructure to kind of give birth to these new applications. Could you kind of like elucidate like this modular stack as you see it? And then we can talk about some of the customizations that can happen at each level of the stack.
Yeah, for sure. So I think generally the way people explain it, they usually take like data availability, consensus, settlement, and execution. I would like to unpack that a little bit probably. I think what you can say is that, yes, you will always have execution. And within that, you have what's really important, things like ordering, what VM that you use, and so on. And then on settlement is a weird way to describe it. I would generally say there's two ways to describe settlement. One is sort of censorship resistance of dispute resolution, which is quite a mouthful. And that is like fraud proofs, so verifying fraud proofs, verifying CKPs. So the ability to do that with pretty high guarantees of security. Ethereum is perfect for this, just because the amount of nodes in the system that are verifying these things are being sent and verified. And then the other one is liquidity. So like a settlement layer can be a home world, if you may, for liquidity that can flow between things that are living on top of it. So all native L1 assets on rollup, so all ETH and most USDC-E for arbitrum optimism lives on the L1. Obviously, you can mint stuff on the L2, but that stuff is, in the case of rollup going down, you can't like exit withdraw this or force withdraw it down to the L1. So you do have that safety hatch with like native L1 assets. So if you wanted pure sort of rollup that don't use any L2 assets, you'd want to do that way, and you'd sort of gain the security there. If you get censored, you want to leave. And then the last one is sort of data availability, and that's sort of what secures all these layers, because they prove that the data has been sent and made available. And on Celestia, this is pretty easy to verify. You just have a light node running. You query these namespace Merkle trees that have all the data saved for a specific rollup, and then you could query any tree and any node in that tree, and you can get the data for that. How like Celestia differentiates here a bit is that it also has consensus on this data availability, and has it very often. Every 12 seconds, you get sort of deterministic view of what has been sent, which is quite powerful. And you also have an ordering of how this looks. This is a little bit different on things like EigenDA. There's no ordering on data availability here. I would like to assume or like think that consensus on the data is pretty important. But I know other people have other views and might not care about that. But it really depends on your use case at the end of the day.
Yeah.
Awesome.
Want to double click on the execution stack. You mentioned there's quite a bit of room for customization there in terms of ordering MEV, which VM that you kind of choose. And I'm curious, this execution stack, is this part of the stack play a big part in this kind of like app should become chains infrastructure conversation? Like, is it this level of ordering and kind of sovereignty and MEV capture that is like the core reasoning behind your thesis of like why apps should become infrastructure, or is it kind of broader than that? Let's kind of dive into that a little bit.
Yeah, for sure. I think what people that are just token holders would say is that, if applications become infrastructure, they can probably accrue high evaluations, right? That's one aspect of it. It's not the reason why I like it. So the reason I like it is that...
Are you sure it's not the reason?
I mean, if your only goal is making shareholders happy, that's what your view would be. But I do think there's reasons why you'd actually choose it beyond that, of course. Otherwise, I wouldn't say that.
Fuel achieves higher throughput by utilizing a novel UTXO-based approach that allows for parallelized execution. This design significantly accelerates transaction processing, which enables Fuel to handle vastly more transactions than non-parallelized systems. Thanks to advancements introduced by Fuel, Ethereum rollups are set to be more powerful than ever before. And Fuel is not just enhancing Ethereum rollups, it's redefining them, making them faster, more scalable, and more adaptable to meet the needs of modern applications and developers. Go to fuel.network, that's fuel.network, to learn how to build on the Rollup OS.
But the way I look at it is that if you are specifically DeFi protocols, the way you can monetize on like a general smart contract chain is very inefficient. And the reason, I think the best example of this is Uniswap. Like Uniswap creates a ton of MEV that ebbs and flows through Uniswap, but the actual LPs nor the token holders don't capture any of it. It ends up in the hands of the searchers that are extracting value, and then they're tipping the proposers, validators, to get on chain. So the validator is actually getting the most of the profits here. But I'm just going to go on a limb. I'm going to say that most Ethereum validators are not necessarily Uniswap token holders. So it doesn't really get back to it that way. It just gets captured by the proposers. While in a perfect world, Uniswap token holders and the Uniswap team and foundation would probably want that MEV to actually be captured by the application itself. That's not the case now. There's even that one tweet by Hayden where he's complaining that you shouldn't be airdropping to Celestia stakers or Ethereum stakers, but rather to Uniswap holders because they're getting extracted from at the expense of others. I do agree to that to some extent. So MEV, like it was one aspect, and the ordering is sort of what gives you that power, because you are, as an application that controls the sequencer, you are the proposer. You decide what gets on chain, you build the blocks. So you can make rules here to do very cool things, and we can touch about that later if you want to. But then you can also extract the priority fee. So currently on like rollups, like Optimism is just first in, first come, FIFO. And you can't really extract MEV here. It's based on like latency and more similar to like Web2 trading or TradFi trading. What you can do is like you can say, okay, if you're going to be extracting value, you should pay a priority fee. So that's what happens with MEV Boost on Ethereum. And then since you're the application controlling what gets put in a block, you can extract that fee, give it back to LPs maybe if you are like a fixed AMM. And that's one way to do it. I think the other aspect of it is also like customization of the way your VM is set up, for example. So maybe you want different gas costs for different opcodes. That could be an opcode that updates an order book. You want that to be expensive. You want that to be cheap. So at DoD Extra we can play around with their VM in that case. We see that, but like Hyperliquid with Avo, and these make a lot of sense now because liquidity in these like perp exchanges is more stagnant. It doesn't have to move around. It can just sit on smart contracts on other chains. You could even change out VMs to fit whatever you're doing. Maybe you want to use a C-level VM for Solana. Maybe you want to move VM because you find it more secure, and you want to build like a secure like environment for funds to deploy into DeFi with. So like a movement for example. You could even do CK things. So, and not to get too technical, like an Ethereum has like certain things you can verify on it, certain types of CK proofs and schemes. However, there are other schemes that you can't verify or you can't run because the gas cost of verifying them is too high. Well, then you can make changes to allow for this. And you could do that on a roll-up as well. So there's quite a lot of sort of customization and specialization that you can get around to. I think ordering is probably the one that matters the most for like DeFi applications, especially if you're in a DEX or an AMM. And just like the free siloed block space that would be less expensive.
I think next we'll get into the mechanics of different ordering mechanisms and like kind of like the trade-offs there with shared sequencers and different ordering structures. I am curious before we dig into that. There's a movie called Dumb Money, and it's all about like this like meme stock Wall Street bet era of 2020, and it kind of traces like the Robin Hood, GameStop type of like arc that happened when it had that huge run up, and it really highlights in like this very like for the normies kind of way. It highlights payment for order flow. And the way that Robinhood was offering free trades to their customers, so all their customers were very happy. They could buy these meme stocks for free, but they were at a disadvantage we want to make sure that we're not recreating a bad system. And so that system where Robinhood was secretly passing this order flow and putting their customers at a disadvantage, I think is very ideologically flawed. I think people would probably agree with that. So I'm curious, like this mechanism that we have on chain now, where proposers are getting tips by the searchers, and the searchers are basically passing that order flow. Are we recreating a flawed system? That's the general question.
I agree with you to some extent on Ethereum, right? So on Ethereum now, Beaver builds, we don't have to get into who those people are, but they build 50% of all the blocks. They're also running searchers, so they are trading against the order flow that they're getting, whether that is from anybody selling it permissionally or somebody selling it to them, and then they can trade on that. So it is very much happening. The only builder, and there's only really 3 active builders now, Fever builds, rsync, and then Titan. Titan is the only builder not trading against the order flow they're getting, and they're only responsible for like 20% of all blocks, which is obviously a pretty big issue. So we are seeing these things that we have seen in TradFi also happen here. I do think there's ways to sort of go around this, and that is the fact that you could do highways within a block. So the searchers that are extracting value, well, okay, we can put them at the top of the block, and they can, front run and do the arbitrage things that they have to do. Or if they want to be at the bottom to back run, we can allow that as well. So you could have like 3 parts of a block: top of the block, bottom of the block, and then everything else. If you want to be put in the top or on the bottom, well, one thing could be you could be a whitelisted searcher. So if you are in these 2 highways, well, then you should pay a higher fee, because you are essentially extracting value. So instead of paying, 0.1% fee to a liquidity pool that, let's assume this is like an application rollup that is a DEX MM. Well, then if you're those 2 highways, you should maybe pay 0.5% or 1%. And that should be redistributed back to your LPs. So in a sense, the searchers are making money, but they're also compensating the LPs that they're extracting from. I think that is a very cool way to go around this, and a sort of a way to still allow these MEV games to be played. And MEV is, in theory, most MEV is good, right? Arbitrage is providing better pricing for users because there's inefficiencies between that and other venues. And liquidation is also important for allowing lending protocols to exist. So I think that's kind of a way to look at it.
So we have app builders wanting to go and launch app chains, and then they have these intricate ways in which they can actually control their order flow and their transaction ordering and kind of dominate this MEV. There's like community members like Rob who are like, wait, no, that's not fair. You guys can't just internalize all of that revenue and kind of trade against their users. So then there's these kind of like diplomatic ways in which we can implement more fair transaction ordering models. Do you see this as an evolution where it's like we're still kind of early to this app chain idea? Maybe this isn't really common knowledge, but over time, as teams start to internalize more sequencer revenue, like this kind of trend accelerates, then this problem might come to light, which could then even further maybe leading to this whole thesis potentially of like, just from a revenue perspective, maybe not necessarily being as like strong as we originally had thought if we kind of get to this less MEV capture. Kind of a packed question, but like, where are we in this cycle of MEV capture in terms of awareness and teams? And is this going to also be, kind of a race to the bottom in terms of sequencer fees, ordering, and kind of MEV capture?
I think we're very early on. I think a lot of people realize this. Hayden certainly does from Uniswap. I think we're seeing the very early aspects of this, and this is because of the availability of what you can actually do with infrastructure now that only makes this possible. So what we're seeing is particularly perpetual exchanges. These exchanges are making their own rollups, their own infrastructure, and are making these different ordering rules and are extracting MEV and so on and so forth. They can do that because of the fact that the liquidity just is sort of stagnant and lives on like a rollup or Ethereum or whatever. I do think a lot of people are aware of this, but the issue is that you do want to do this on like a DEX AMM. And here I'm specifically referring to an AMM that has like liquidity pools. You always need to attract that liquidity first. And most of that liquidity at this point lives on these generalizable chains. So you can't make atomic calls to this because the liquidity is living there. You have to attract it first. So that's like one issue. I think we're very early there. I think there are ways to sort of do these succinct global state layers or even like a shared secret setup where you can do these things a lot easier, and it's less of an issue having this liquidity fragmentation. So I think we're still quite early on this, but I definitely see people becoming more aware of these things being possible, and sort of looking at ways they could do this with, even on Maker, for example. So I think we're going to see this sort of happen slowly but surely, and we'll see people sort of experiment with this. One thing you could do, actually, if you don't have like LPs, let's say you just have like an order book, you could also write this into like a sequencer rule for how a block should be built. Or you could even do, even if also with LPs, for example, or even without LPs, you could do these rules where you have like, okay, you can only do buy, sell, buy, sell, buy, sell. And you can only do sell, sell, or buy, buy if the price at that point is better than at the beginning of the block, or if there's no trades in the opposite direction. Essentially what you do with that is you say, okay, nobody is taking advantage of me and getting a better price. So that's like a very cool way of doing it. Because you're not moving the price for anybody else. So you're not, nobody's using you to extract value. I do think that's a cool way to do things like this. And I could definitely see that happening. And you could write this into like the sequencing rules for your rollup. That's like one way to do it. I think these things will start. I mean, we're seeing research on it now. There's a great paper on this in particular by a guy called Ferreira that goes into some of these incredibly like fair ordering. But you can already build this with a rollup if you want to inherit security. So yeah, I could go build this as like run a singular node off chain and like execute these things before they hit Ethereum and bundle them together. But I'm not really inheriting any security. And that's sort of what you get from building a rollup, that you can inherit some security or inherit some liquidity while doing these cool things.
There was a really interesting phrase I heard you say then, which was that the succinct global state layer. And to me, this idea of a global state layer sounds like one blockchain to rule them all, which I think is very ironic to hear you put it that way. And then also have this modular thesis that we talked about in the beginning of the conversation. So I'm curious, like, first of all, just first principles, what is this succinct global state layer? And then how do you balance this with kind of like the modular components that we talked about in the beginning of this conversation?
Yeah, so the way I look at it is that it's kind of a mixture of modularity plus monolithic ideas. Some people have called it like integrated. I guess that's the way to put it, but I hate coming up with new words to describe these things. I would just say it's mixing modularity with monolithic. So the idea is to have like a very succinct, maybe even without like consensus, that just provides settlement abilities for like CKPs, for example, and also data availability, for example. That could be one thing. So you have this one succinct, very efficient global state layer that has state for, that could be like state differences, or it could even just be raw transaction lists sent from rollup. It has all of this and holds all of this for all of these rollups on top of it. So this is sort of where it becomes monolithic to modular, right? So while Ethereum is like a global state layer, you have atomic composability between every smart contract within Ethereum. And the same goes for like things on top of a rollup, but it doesn't have that with things on Ethereum. So the idea of this essentially is to have this very succinct, very efficient, what Mina used to call itself. They used to call it like a succinct state layer, where you have these CKPs that verify things being true or not. So what you could do is that you can have this succinct state layer essentially operates as like a ledger for all these roles on top of it. So you could have, let's say, 15 different rollups that are siloed execution environments. They're running their own sequencer. But the magic here is that they can become very efficient at communicating with each other. So currently, if I'm on Optimism and I want to go to Arbitrum and I want to go the native way, I have to wait 7 days for like withdrawal periods, for example, which is obviously very inefficient. Or I can go through like intent switching protocol where somebody's fronting me this money and they'll take that risk and take a small fee. The issue is that you can't do atomic like smart contract interactions between those things. Like intent solvers can't fix that problem. They will never be able to communicate atomically because they're not within the same block or the same state. So what you do have is this sort of succinct global state layer is that you'll have 10, 15 rollups, maybe even more. And then you introduce like a special actor. These are all siloed execution environments, but they're all sending their state updates to an underlying layer. And they're sending likely like a CKP to verify that execution has been done correctly on these state differences. So what you introduce is an actor called a composer. So Astria has this in their shared secret setup, and more people are coming to sort of know about this sort of type of actor. And this actor essentially simulates cross-domain transactions or cross-roll-up sort of interactions. So this means you could have atomic composability while having a siloed execution environment. So imagine 10 different AMMs and DEXs and yield aggregators and lending protocols all controlling their own environment, controlling their own ordering, extracting MEV. But when they want to make atomic calls, which a lot of applications do on Ethereum today, like a lot of these DeFi is built as Lego blocks on top of each other, and they have to do atomic calls to each other or they stop working. If you could do that, but also control your own ordering, that is kind of powerful. Because you could have your own rules about your VM and the way you want to handle MEV, while still being atomically composable with other applications. And this could even extend to like, okay, some people in the US might not want to have their funds commingled with other regulatory areas. So that could be like sexes. Maybe you have like a Binance rollup, crypto.com rollup, an OKX rollup. And while you can still like atomically go between them, they wouldn't have commingling of funds unless desired to be. So I think that's the way to look at it. So it's sort of a mixture of modularity with monolithic. In a way, it's like Ethereum maybe 15 years from now. Like these are sort of the ideas that Vitalik and the rest of the Ethereum Foundation are thinking about things. It just takes very long with the technical baggage that like an Ethereum has to actually build these things.
Sounds like the ag layer.
Yeah, so a Veil and even Polygon are sort of exploring these things as well. You could kind of think as a nexus of a Veil is kind of the Astria that Celestia has. Obviously, Astria is not built by the Celestia team, while Nexus on the Veil is. And these are essentially just like integrated settlement layers that provide global state and like atomic composability for these siloed execution environments. And then you could like introduce solvers and intents into this world as well, where like, okay, I am using some, universal front end and I just want some outcome. Well, then a solver goes to any of these rollups that are atomically composable and does that for me. That could be one pool that's more efficient pricing than one other one on a different rollup. That's sort of the end game, I think, for Veil and Aglayer from Polygon, and also sort of what shared sequences sort of becomes with Astria, for example. You are sort of a settlement layer for intents to some extent.
So then bridges, as we know them today, just kind of become, they might either just be obfuscated in the background for other use cases, but it seems like due to the lack extensibility of the common bridges that we know today in terms of being able to be present on thousands of app chains, it seems like some of these Nexus, Astria, shared sequencer, even like hyperlink kind of models, proof aggregation models like Union, Polymer, and kind of some of these models are going to be a bit more flexible and realistic for like this absolute extensible scale of chains versus like the traditional bridge model.
Yeah, often these like cross-chain communication protocols like bridges, the issues they often have is that the execution is asynchronous. So I'm dealing with two blockchains that have different block times. So that could be an Ethereum with like 12 seconds. And that's only like a subcommittee of the 1 million validators that I actually said yesterday. So the degree of security is not that high. That's why we have these confirmation times and we wait for these things to happen. Like with a CKP verification time being like, you want to probably wait like 12 minutes to ensure that it's not getting reorged. So the issue is sort of with these things and the bridges that we have currently is sort of you're dealing with asynchronous things. If you can make these things synchronous, particularly just for like cross-domain things, that does make things a lot easier. What I still would say here is that you'd arguably still want standards for how cross-chain communication should be done. So something like an IPC makes a lot of sense because you have standards for how messages are bridged across, and you have standards for how this is verified as well. So that's probably a good way. We have no standards really today. Every single cross-chain messaging protocol has their own standard. I think we're seeing IPC sort of take the lead a bit here because we already have a pretty safe messaging standard here. We have things we can do within IPC, like in-chain queries, we have in-chain accounts, and these things allow for some very cool things. We'll probably see like in-chain accounts on Celestia as well, and you can start to do some very interesting things if we get CK support here as well. I don't think bridges are dead in like a succinct global state layer setup. Maybe standards will spring out more, but there might still be things that you want to do, right? And I don't think like maybe the end game is that we have one global state layer to rule them all. That seems unlikely though, just because of how the world works, right? If that was the case, we would have NATO of the UN control the entire world, and that's just the way that things would work. That's not the way things are played out. We're all very different. But maybe we'll have a few of these types of setups. That could be a possibility.
Yeah, we'd have our troops over there at your front door for being a bad VC.
That could be a problem. I know the US have extended their reach at times.
Navigating multiple blockchains can be complex and cumbersome. Let's say you want to deposit into a lending market on Polygon because they have the best rates, but you only have funds on Optimism. So you bridge your funds to Polygon only to realize that you need Matic to pay for gas. Maybe use a centralized exchange or you ask a friend to pay for the gas, but only then can you finish your transaction. In a chain abstracted future powered by Connext, this is not the situation. You can connect your wallet to any dApp from any chain with all the complexities of swapping, bridging, and depositing, all completely abstracted behind the scenes. Head over to connext.network, that's connext.network, to learn more about Connext's Chain Abstraction Toolkit. With these chains that are plugged into, this, let's call it a global state layer, there's still the risk of reorg, right? And so some of these bridges have been able to solve that by fronting capital, and therefore the solver is the one who fronts the capital is taking on that reorg risk. In this synchronous case of interop, is who's taking that reorg risk? Is it the composer?
You're right in the nose. So the composer exists to ensure that there's no double spending of state. Obviously, you could have a communication channel between the two of them, and they have consensus between. That's the way IBC works. IBC is not atomic, and they sort of come to agreement. They have their own validator sets, and they run light on each other, and that's sort of the proof that they need. The composer in this case sort of fronts that risk, and they ensure that you're not double spending state on these two rollups that are being interoperable with each other. That's the way I would look at it, and then you sort of get away from reorg risks as well. This composer is likely going to have to be running, in all likelihood, full nodes on each of these rollups, which is obviously a pretty intensive task. So you have to be very specialized to do this, to ensure that they've actually executed these things and put them in a block, and not double spend the state or whatever they might have done. You could get around this by doing things like storage proofs. So you could prove that, this particular transaction or smart contract interaction has been put into a storage slot in the global state tree, and you could verify that with CKPs. So something like a Lagrange, for example, or an Axiom, or many others, you could do that kind of setup. That's one way to get around that, but you are putting a lot of trust in this actor, that's for sure. And it will be a specialized actor, just like builders are specialized actors today on Ethereum, for example.
Could you kind of highlight what is Lagrange? What role would Lagrange or someone who does these because there was a lot there, and I think that is kind of the crux of why we don't see these shared state global state layers now, is because it's very difficult to manage state from more than one siloed environment, and yep. So we have all of these modular sovereign rollups that are all kind of existing in their own app chain world. But then we're going to take the state of each of these chains, and we're going to combine states from multiple chains into one global state. So we've heard Ishmael from Lagrange talk about these state committees. We've heard we heard you say state roots or state storage proofs. How do we how do we understand that? What is a state committee? What is a storage proof? How do we correlate or corroborate all of these states into one global state?
Yeah, so the issue with state is that it grows very quickly. So Ethereum state grows very quickly. Solana state grows even quicker. So it puts a lot of pressure on the hardware and the validators of these chains. And if you want to increase, the state amount of compute on the right state that you grow, you have to increase the hardware requirements. And that's, then you lose the centralization, and that's the entire sort of a debate that is happening on Ethereum, right? Should we lower our validator set and then increase the hardware requirements so we can have less validators, less people checking the chain, but increase the amount of transactions we can put out per second, or the amount of compute we can have per block, for example. Solana takes the other side of that coin. So in theory, if we have 1,000 different chains, imagine the amount of state. No single SSD could probably run this. And one of the things that you can do with like state and like what a mega ETH is doing on like a monad is they're like optimizing these databases and they're keeping all like execution state. So this is like state that is actively being dealt with like on SSD or in memory. And that makes it a lot more efficient to do things. And then you have like old state that you archive and you have these archival nodes. And like the security assumptions there are pretty safe. It's like a 1 and n. As long as one person holds all of this archival state, it's pretty safe. But if we want to interrupt between these different chains, well, either we have one actor that runs like a full node on all of these. That's pretty inefficient. And it's pretty costly. So if these are like very high scalable chains, the hardware is cranked up, and then you're running pretty extensive hardware. This hardware might not even be regularly available. It might be like a bare metal setup that any normal person would have like access to, either because of funds or because normal hardware stores don't sell this. So one thing you can do, and this is sort of where these storage proofs come in, is that you could have what like Ranch does, for example. They have these state committees which are taking this job of running full nodes on all of these different chains, and then they are taking what they call BLS signatures. So these are signatures on each block from the leader or the set of validators that are signing onto this block. And then you can aggregate these together. And then you can essentially, when you're running a full node, you have the storage, you have the state that constitutes all the information about what people are doing. And you can sort of prove that you have the signature of these validators signed on, so this is true. What you can then do is you can introduce like what Lagrange has these called reg proofs. There's like aggregated proofs that you can continuously build together, and you don't have to recomplete everything because you already have part of the state. So you don't have to run all the state through a CK circuit again, which is extremely expensive and extremely hard to do. So you can sort of aggregate all these blocks together, update this proof every time, and you then have a proof of this state existing. And because of mathematics and like cryptography, we know this is true. So then you can provide these storage proofs and say, okay, this sequencer of this rollup, or these 5 sequences of this rollup has signed onto this. This is in a block. It's been executed. We can see that right here. What Lagrange then take it a step further. They do like an AVS type setup where they have cryptoeconomic security on this that can then get slashed if they act dishonestly. So the way to think of it is like storage proofs can take away the trust assumption that we put in like a single actor like this composer. Because if we didn't have like CK here, you're essentially trusting this composer that they have your best interest in mind. And like there's game theoretic reasons for why this is true. And they wouldn't act against it because it's their best interest to continuously be a part of this protocol. You can also do like optimistic things, but as you know, with like optimistic setups, the wait times are quite long. So you can't really finalize things that well unless you trust them completely, which is like the role of like a relay and MEV boost on Ethereum. And sorry for the rant, but it's kind of the way to look at it.
Yeah, no, this is awesome because this is kind of like the end game that I think is where a lot of these different verticals converge. It's where interop meets ZK meets intense meets modularity. And so this ultimately provides the best UX. It's just a matter of getting there. And so I just want to make sure that we all kind of like understand like this architecture of this end game, because you mentioned that we have like this one kind of like rudimentary possibility where one operator can run nodes across all these networks, full nodes across all these networks, but we have to trust that operator, and then they basically have complete control, and all we can do is basically trust them. An alternative is that instead we construct a state committee made up of these independent validator sets. And so therefore we don't need to trust a single operator to run a full node on each of these networks. We can just say that the rollups have their own independent validator sets, and then we aggregate these BLS signatures that each of these validator sets sign off on.
It was completely correct apart from one thing. The state committees would not be the sequences themselves. It would be operators running like a full node on all of these different sequence of rollups or chains. And then they would be able to see the signatures have been committed to this, and they sign on to this transaction in this particular block. So you would have you wouldn't have the validator themselves, because then you might get some very tricky sort of dishonesty that could happen here. But it would be like operators that can run full nodes. So even on rollups, like you can run a full node on like Arbitrum Optimism. It's actually one of the easiest places to probably run a full node because there's like constant updates happening there. So that would be the role of that state committee. It wouldn't be the sequences themselves, although you could argue that this could be a good idea as well if they put up a certain amount of stake. But the general idea is that if we just like an operator, like a Figment or a Kiln, or many of the operators we see that are validators in the Cosmos ecosystem.
And why might Lagrange or like how would a slashing event occur? Like what might trigger one of those events that would trigger a slash of one of these operators?
That could be because one of these operators that are running these full nodes have essentially committed. So that's why data availability is important. And everything comes back to data availability at some point. Let's say that they have committed some data, or some data has been committed by the sequencer. What the full node is saying that the output is actually different from what the data availability shows. And they have then constructed a proof on their own data that they have done dishonestly, and then has sent that in. So this proof is based on something completely different, and maybe gives them money to their address that they have in whatever chain it might be. That would obviously be able to prove that, because that's why like data availability is super important for CK proofs as well, because it proves that the CK proof is actually correct. So the slashing event could be that different DA has been committed, and the DA proves something completely different that what are actually being given by this state committee operator. So that's how a slashing event could happen, and then that operator would likely get slashed.
Yeah, it makes sense. It comes back to the original point of kind of the state reorg problem, and that's a catastrophic problem, and whatever we can do to kind of disincentivize people to participate in a system which leads to that problem is a necessary step to take. As we're kind of discussing this, I can't help but think that there's many ZK providers working on this kind of single global state. There's many data availability layers trying to provide a last bastion of truth. There's multiple shared sequencers trying to create this synchronous composability. Whereas I think when you first started some of your research, there was really like Celestia and maybe Astria and maybe Espresso and a couple other teams. But now we've kind of got this competitive landscape in the modular world, and I kind of want to dive into this concept that you wrote about commoditizing your complements, where it's no longer just, you can pick one provider for each part of the stack. It's like there's now a selection of providers, and we see teams kind of positioning against each other. And so, yeah, let's dive into this idea from Joel Spolsky, originally brought to light, I think back about 20 years ago, where we had this idea where basically the goal is to increase innovation and profitability in a sector by commoditizing the complements of your product. So, in Astria's case, we have them being a shared sequencer, they're kind of commoditizing RAS. And so we can kind of dive more into this. Why don't we start with your here as to why this is going to happen in the modular space, and then talk more about some of specific examples.
Yeah, so the way I look at it is that in an end game where like narrative and BD isn't what matters, like only what matters, but the actual prices of the things that you utilize to build your product matters. So in like Web 2, the market is way more efficient, right? Usually if I'm providing a cheaper product, I'm likely to get more demand. Like that's just a rule that exists. Is if it's cheaper, I'm going to get the more demand. In crypto, this is not the case. Otherwise, Ethereum wouldn't be the sort of the settlement layer to rule them all at this point. So the idea is that in a world where the crypto and blockchain community is way more mature, it will be more important to lower the cost of the things that you're utilizing. So what you can start to commoditize, you could take Astria as like an example. DA is obviously important. It's important for all rollups. So utilizing the cheapest DA is obviously pretty important. There's a caveat to that because it is security related. So you probably want, deterministic DA. You probably want relatively slow block times comes with that determinism. And you probably want the scalability of this to be able to grow. So that's like where DAS comes in, for example. With Astria, what they're also trying to commoditize is likely going to be like running a sequencer, like proposing stuff here. And one of the aspects of that is that if you can lower the cost of sequencing and lower the cost of launching a new rollup, you can kind of outcompete like rollup as a service providers, because their cost is going to be much larger. And this ties into like aggregation theory a little bit, because it's much easier for Astria to monetize rollups because all the rollups are going through their shared sequencer. And all the liquidity sort of lives within that shared sequencing setup. So what you kind of see with like a REST provider, they will have some cost associated with it, and they'll probably take some overhead because they have to sort of they have to run infrastructure or contract somebody to run the infrastructure or hope that the customer themselves can run it. And obviously they can probably provide like more white glove services. So there are like specific use cases where you'd probably want to go to like an actual REST provider. But the idea with Astria is that you could probably get to the lowest cost of running any rollup by going through this. So if I'm going to launch a rollup and I just want the cheapest way to do it, and I would like to communicate with a bunch of other applications that might have liquidity or users that I want to vampire attack or I want to tag into, then like going to like a shared sequencer makes a ton of sense. And it also makes it a lot easier for that shared sequencer to monetize. You can kind of view it as a bit as like Visa to some extent. Like the margins that Visa take are quite small, but Visa is running, for a lot of different merchants. They're running for millions and millions and millions of people. So even though their margins are small, the amount of volume that goes through it makes this margin worth it. And you can sort of look at a shared sequencer to some extent like this, is that they can service many, many, many rollups. Hence the reason they have to be lazy. Because if they were running full nodes we talked about earlier, the cost of this would be enormous. And you'd just become a single chain, like a Cosmos Hub.
So
or chain security or like
Astria,
a Polkadot, for example.
And the example from the RAS perspective, which, and I think that the Visa example in terms of volumes is super applicable as well. Let's zoom out from just RAS and shared sequencing, and let's build a app as a rollup, and discuss each part, kind of where you see this commoditization of complements going. So we've got things like RPCs and composers, shared sequencers, DA layers, VMs. So as we're building, as an application builder is building a rollup to try to get the best UX possible, we're getting this all these options of outsourcing and plugging in all these different pieces to build your rollup, which you kind of mentioned ends up in like this like API economy of Web 2, bringing over to Web 3. So let's talk about each kind of part as to how you kind of think about the commoditization or the kind of commoditizing your complement strategy at kind of each part in the stack as you're building a rollup.
Yeah, I think as a rollup, as an application developer, you kind of start out with, okay, what kind of security do I want to inherit? Do I want like shared security? Do I want some operator with some crypto economic security behind it to also be a part of my application infrastructure and actually run like a full node for me and verify these things? So that could be like something like EigenLayer. The problem here is that you probably have to pay some inflation, or you have to give away a part of your fees to make the operators and restakers that are giving you crypto economic security happy. I don't think that's scalable for most applications. So what you're likely going to want to do is go with a DA layer. So take your pick, a DA layer that is, you're just paying a DA fee to, that you're paying for because they're putting this into a block, so you're paying some transaction fee. So the first is to pick a DA layer. There's going to be a lot more choices. Right now, the only real choice I'd say is Celestia, and also Ethereum at this point. With like post 4844, the costs are going down here quite a bit. But then you come into like the quality of this DA, and is that scalable 4844 in the long term in terms of how many blobs are available? There needs to become some changes here, and this could become a problem as we grow over the amount of rollups. So yeah, you pick a DA layer, and these are starting to become commoditized, even so some people would say they are not. There's aspects of like the quality of it that you can like get into, but generally, you could say they become commoditized. The next area is like, okay, I'll probably just pick like an SDK, because I need to build my rollup. I need to build the things that are important for a rollup, state transition functions, VMs, and so on and so forth. We're seeing a ton of different SDKs. We're seeing Sovereign Labs, there's the Cosmos SDK, OP-Stack, Hyperchange, I think they're called, from CK Sync, and many more, Rollkit, roll chains. There's so many of these different SDKs that you could utilize. These all have trade-offs as well. Some of them, most of them are going to be free, but maybe they're expecting you to utilize one aspect of their thing. So like with an OP-Stack, if you're choosing that, you're likely doing it because you want to be close to a base on optimism and you want to be a part of that super chain idea. So that is one thing that you could do when you're choosing SDK. Maybe you want Sovereign SDK because it's more performant with their DB and like parallelizable Merkleization changes. that get you closer to like something like a monad. So that could be one choice you could make. Then you also get into, okay, I've now picked my CK, I've picked my VM. These are all like commodities, they're free. Maybe I need some CK aspects. So you're like, okay, I might go utilize CKVM. Most of them are free. They're pretty much all free. But there are funnels, as I've talked about earlier, into sort of things like a bonsai, which is like a proving market. So these are like the aspect you go over. And maybe you don't want to run all this stuff yourself. Maybe you don't want to decentralize your sequence set yourself because you need to orchestrate infrastructure providers. You'll probably pick like a shared sequence if that's what you want. And you want to be composable with other things. But if you're like an application that has a lot of users, dependent on liquidity, well, you can just do your own thing. Right? You're not required to do that, but that is an option. And maybe you have funding to like orchestrate the infrastructure providers. They don't necessarily need to go to shared sequencer. Then I think that's the most interesting aspect of this is like, how do you think about MEV? Right? Are you making changes on like a block level, on a sequence level? Or are you saying, oh, I want to outsource this? So what we talked about earlier with ordering an MEV, you can also say, okay, I want to outsource this. And I say, okay, I want to go to a Suave. And on Suave, I can have, different types of auctions for MEV transactions. And I can have, searchers and specialized builders build these blocks for me. I don't have to think about it at all. But I can probably get some kickback from MEV profits. So that's one way to think about it. And I'm probably just paying a small fee. And then there's also RPC providers, right? Or I think most of the time, what we've seen with most applications that they'll use like some centralized RPC provider. There's some cost associated with this, some subscription fee. What we are likely to see and what's happening slowly but surely with Lava, Pox, and a bunch of other RPC providers that they're building these sort of decentralized network where you can pay with like a token. Obviously, there's some open-ended question says that, okay, what if the price appreciation of that token goes up so much, but the amount of tokens I have to pay is the same, then the prices can be going around quite a bit. But if it's just stagnant in USDC value, that obviously becomes quite interesting. And they'll probably be competing on this. So as we sort of try to commoditize aspects, I'll get it to the end point here, everybody will be competing against each other to provide the best quality at the lowest cost, because they want users at the end of the day. And that's sort of what we're seeing in Web 2 and sort of tech startups, is that you have all these API economies that you can tag into, and generally they're all competing to provide the best product at the lowest cost. I think we're starting to see this in crypto. I think Modularity sort of accelerates this.
For the users too.
And for the users as well at the end of the day.
This is our thesis. Like I just wrote a tweet about this today and people ask like which part of the stack is going to accrue the most value. And frankly, the way that you describe it, it's like everything is going to be like kind of commoditized as low, as cheap, as more as efficient as possible. So it's not like necessarily and maybe you have a thesis on this, but it's not like Celestia necessarily may ever be like this extremely profitable revenue generating machine like a Solana does from MEV, for example, or like a traditional business. But if Celestia can provide builders with a tool that will give them a much cheaper user experience and a better experience, then that end product can be worth so much more and be adopted at such a faster scale. And end up kind of like the way that I think about it is like, okay, where are all these hit apps that I think are going to come out of this modular stack built upon? Well, they're built upon Lava, Celestia, Espresso, et cetera, et cetera. And so our kind of thesis.
Yeah, I would love to talk on that actually. I think you're hitting it right on the nose here, especially on MEV, right? So where leadership election happens in the stack, which is execution layers, right? So the rollups, the apps that control the ordering, they essentially extract all of the real value. If everything is commoditized, every gas cost is super low, compute cost is super low, maybe because of like GPU networks or whatever, then the real value comes from MEV and the value that creates. And if you can extract that MEV, which happens on the leadership election area, which is generally the execution layer, unless you do like a base rollups, and then you'll give away your MEV to the DA layer, consensus layer. But I don't think any application will
Ethereum
want to do
alignment,
that.
Baby. Nah, come
Maybe
on.
You want
Ethereum
alignment. And that's the other aspect of it, right? Celestia, even though DA layers could become commoditized and super cheap, and the amount of fees they accrue might never really be worth it, I think there's a world where it is. If you have a ton of rollups, like the end game we might get to at some point, then that does become a lot for validators and Celestia stakers. what you kind of have is alignment, right? So I mean about this, I say like the most powerful aspect of block space is alignment, where you could say a rollup right now, they'd very much like to be aligned with Celestia, because Celestia will probably talk about them. They'll tweet about them. They'll give them partnerships. They'll connect with other rollups, etc., etc. If I'm a rollup on Ethereum, the Ethereum Foundation is not going to go retweet about my rollup, right? They just don't do that. So one aspect is you say, okay, I want Celestia stakers to be users of my rollup because they're likely to be interested in this because they're modular focused and they're holding this because they believe in it, whatever it might be. So alignment can be very powerful, right? And that could give value to something because, maybe all these 1,000 rollups, they're going to be airdropping tokens to these Celestia stakers. That could be like one thing where you say, okay, this is like the extra value you get on top of the fees is that alignment value. So how do you value alignment? If you look at like an eigenlayer, clearly people value alignment pretty high. You could say that about DA layers as well to some extent, especially if we're in a world where everything is just commoditized. And how much do you want to pay for that alignment, right? How much are you airdropping? How much are you giving away to eigenlayer restakers as an ABS, for example?
Coffee,
so that's the way I would probably look at it.
I think that we're in the same boat, man. We're going to ride this modular expansion together and see you in ETHCC for a beer and hopefully a much more fully fledged modular ecosystem come July. It's only 2 months away, so but I've got
very close. Yeah, we'll be holding the Modular Summit again. So Celestia and us will be hosting the Modular Summit just after ETC, 3 days to sort of highlight everything and anything in the modular ecosystem. And just to say, like, the modular ecosystem is just not just Celestia, right? This expands outside of this as well. So, you'll probably see Ethereum rollups as well. Maybe you'll see, settlement layers. Some of them might be using Celestia, some of them might not be. So I think there's a lot of stuff here that would be very interesting to see. And we're still seeing the very, I think, start of how modularity can help applications. People are slowly sort of realizing this, and I think we're in for a very interesting year in terms of how applications look at the end of it.
We couldn't do it without you at the summit. Bad VC. Thank you so much for coming on and supporting our favorite projects before we even hear about them, making this industry possible, and having a modular haircut, man. Thank you so much. It's been a pleasure.